Gold has been reacting very interestingly to micro news. Jerome Powell being hawkish, Donald Trump announcing tariffs on gold and then taking them off again. But gold is moving $100. Like, why is gold reacting like that? I've invited a fantastic guest on the program to help us understand the fundamentals of gold and why is it moving and behaving the way it is right now. Gold has moved from $1,900 to $3,500 without even flinching almost, and we're trying to dissect that. Like, what is the gold price made of right now? Is it geopolitics? Is it the micropolitics? Is it the tariffs? Is it the end of the world scenarios? Maybe all of it we'll have to discuss. I've invited Dirk Baur. He's a professor of finance at the University of Western Australia, and a big part of his research is focused on gold mining stocks, and safe haven investments or assets. So really looking forward to this conversation because it'll really help us understand better why gold is behaving the way it is. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously and we much, much appreciate it. And by the way, it's free. It doesn't cost you a thing. So thanks so much for doing that. And now it is my pleasure. Dirk Baur, thank you so much for joining us. It's a great pleasure to have you on Soar Financially.
Thank you. Pleasure to be here.
Yeah, really looking forward to this, Dirk. Maybe we'll start with almost a general question, but we need to deconstruct the gold price as it is right now. We're trading around $3,400 an ounce. If you were to draw a diagram, maybe like what does the gold price consist of right now, Dirk?
Well, we have a couple of components. There's jewelry demand is the biggest part, around 50%. And then we have the financial demand, investment demand is 20, 25. Then we have a little bit of industrial demand, very small. And then we have central bank demand. And the big chunk or the big part the big change was in that central bank demand, as is well known now that central banks have, after many years of selling gold in the 1990s, and after that, recently they have started to buy more gold, and that is that component that has really changed and potentially pushed the gold price up a lot. Explaining what you said, the movements in the last 5, 6, 7 years.
Yeah, a lot of the demand, like jewelry demand, you said 50%, but like what's been driving price? Like if you were to dissect the $3,400, how much of that is jewelry demand? How much of that is geopolitics? How much of that is central bank buying, which we could almost throw into geopolitics probably as well? Because if we were to draw a Venn diagram, it probably overlaps quite a bit. Of those $3,400, like what was driving price the most and why?
Yeah, so I mean, we have supply and demand, right? We know that, and the supply of gold is relatively constant at around like 3,000 tons per year. We come to mining later, so that cannot change quickly anyway. So that's relatively stable. And then the other side is the demand part, and that is that can vary more, and it has been more variable, much more. The jewelry demand is relatively constant, doesn't change so much. The finance, the investment demand changed a bit more, but also relatively constant. Industrial demand also relatively constant, and then the big difference is the central bank demand that has changed a lot, right? And that's when you have supply and demand in equilibrium, in balance, and then you think of one component out of 4 that changes a lot. In this case, it is central bank demand. Then that explains why the price went up a lot. And you were right that that central bank increased demand is also linked to geopolitical risk.
Yeah, it's like it feels like we're having a very simple conversation here. Just like the fundamentals, people are not. But the move from $1,900 to $3,400 or $3,500 was quite aggressive. Like I mentioned in the intro, is like it happened without really flinching, because some of the fundamentals like jewelry demand or so, they've always been there. They didn't really move the needle. It was always, as you said, like sort of in balance, supply and demand. So it didn't really drive price. But one thing has really changed like within the last 18, 24 months. And I'm really trying to work that out, how much of a component that is, because I want to come to that, how much of a factor can it be on the downside as well later on. So I'm trying to understand like how much of a factor was it to the upside? How much of a factor will it be to the downside later?
I mean, I mentioned the central bank demand, but then we have also this added something that came in the last couple of months, Donald Trump, right? I mean, Donald Trump was, well, like his election was considered to be some geopolitical risk, I think, right? And some uncertainty. That uncertainty also is good news for gold. And then since he came into office in January, there was a lot of news, a lot of information that I think helped gold as well, right? Because going back and forth, this taco label that he has, that has helped gold. There are two big, not only the uncertainty, but there are other two components. The one is that, of course, tariffs increase inflation. If you think that gold, or people who believe that gold is an inflation hedge, or that gold increases when inflation goes up, then this also then helps and explains part of that, right? And the other part is that geopolitical risk, but also this move away from the US dollar potentially. I think one could make the argument that Trump has helped to I mean, also the Europeans to think more about, well, is the US still the ally? What role plays the US dollar? And then that could also have led to a rethinking of the global role of the US dollar, right? And if more countries try to diversify from the US dollar, then that is also potentially a push for gold. There are two effects here. When you diversify away from the US dollar, you will probably sell US dollar reserves and buy gold. That's the one component. And the second one is that because then when people do that, the US dollar depreciates. And there's then this inverse link between gold and the US dollar, right? The gold is priced and denominated in US dollars. So if the US dollar falls, gold goes up. So there's then two things that push it up.
Are you seeing general like fundamental changes in the marketplace? Like you've been saying, like, okay, this is the market reacting to politics and like maybe announcements and uncertainty from the political side. But do you see underlying trend changes? You say of diversifying away from the US dollar. Is that just a current like trend that is just in fashion, en vogue right now? Or do you see this as a longer term trend as well? I'm trying to figure out like how that really factors into the price discovery.
Yeah, sure. I mean, I think that diversification makes a lot of sense in general, right? I'm a big fan of diversification. And that also should matter for countries and central banks. So if they then, I mean, China like had huge US dollar reserves, right? I mean, it was always surprising that, I mean, they had that. Well, this big amount of US dollar reserves also gave them power, negotiating power, I guess, because when you have a lot, you can then say, look, if we sell all of those, that's bad for you. But anyway, China has grown a lot, is a huge economy now, and it makes a lot of sense for them to diversify away from the US dollar and also to try to, I mean, they want to make the yuan like a more important global currency. Other countries may also like that. India is a big country too. The euro is already becoming stronger. So I think I don't think it's a fashion. It makes to me a lot of economic sense that we see a diversification away from the US dollar. So it's not something that I can see a long-term trend here, right? I hate to make predictions, and it's a conditional prediction in the sense that if, and I think there is a strong case for it, that central banks, governments want to be less reliant on the US dollar, then I don't see why this should go away and why that is not good news for gold.
Given all that context, and I don't know, there are nuances to it and there are a lot more facets to it, like, would you say gold is overvalued, undervalued, overhyped? Like, what category or what stamp would you put on it right now?
Yeah, I like the efficient market hypothesis. I like that very much, right? So that the price is the current market price is the market price, and I don't see why it's overhyped or underhyped or whatever. I think the price gives us what this is a pretty efficient market, the gold market. Right, it's not that. There are maybe other commodities and other markets where you can say, look, I mean, this is probably the price is too high because there's supply and demand is not in balance and all that. But for gold, I think the price is right, but that doesn't mean that it cannot change, right? I mean, it is highly sensitive to global news, gold, as we know. And so if there's a big shift in information, in geopolitical risk, a big change, that could also change, that will change the gold price. right? But I think today at this level, it seems high, yes, and it went up pretty fast. But I mean, given what I just described, increased central bank buying, geopolitical risk, uncertainty, inflation fears, I think it is correctly priced at today's price.
I know you've done research on like comparing gold to other asset classes. Like I've seen a gold copper ratio, for example. Does that stand out? Like, and how does it compare on a historic basis to those ratios? Like, how far off are we? Are we just golden right now? Pardon the pun there. Quite intentional. But like, how does it stand out? Like, is everything solid? Like, is anything standing out? Is my question. Sorry.
Yeah. I mean, the performance of gold is outstanding, right, relative to other assets. So in that sense, it is special, right? But of course, then if I compare gold with the stock market has pretty high valuations currently, but gold performed, as we know, very, very strongly in recent years, and so it stands out. But of course, when you compare this to AI stocks or Nvidia and Bitcoin, the performance is not that stellar, right? So it always depends on what you compare it to. But I said that before, that I'm also a little bit, I'm not surprised when I look at it now, that given what we see in the world, but I mean, this I didn't see that coming in a couple of years ago, that the price would go up like that, right? But it's in good company. Many other stock markets also have very high valuations, right? And you need that. Then the gold price should also go up if you want to hedge, like diversify your portfolio and also have gold included in it. Then it's not surprising that when stock markets go up, that then the gold price also goes up with the stock market. That's also something that has changed. Like my research has shown that has changed in recent years. That clearly, when investors did not use it as part of their portfolios, then there's no need to that the gold price then moves with the stock market. But when more and more investors do that, then the link should be stronger, and that also explains it. There's another component here that explains that.
Yeah, like you were talking about the investor, and I think we need to talk about maybe psychology a little bit as well, because you do investment, or not investment, research into like safe haven assets, and gold, of course, is one of those. How much of a role does that play in people's portfolios and minds right now? Is it just, I'm buying it because it's going up? Is it still that safe haven investment? Is it a hedge? Really curious what your thoughts are on that, Dirk.
Yeah. So it is a safe haven, clearly. When we look at the past financial crisis, like the 2008 crisis, COVID, even the ones before 87. So when there is 2001, the terrorist attacks, when stock markets fall, people are looking for a harbor, a safe harbor, a safe haven, right? And then what comes to mind, it's also historically then a lot of people then go into gold, and the alternative is into government bonds, high quality government bonds. So this is something that, think of it like you're in a stormy, you're on a ship, and then there's a storm coming, and then you're looking for a port right there, because the port provides safety. So that's what we see, and it's pretty consistent for gold still. Will that the difference to a hedge is, the hedge is you have gold in your portfolio. You may also have other assets in the portfolio to diversify the risk, but that does not, like a hedge, that doesn't protect you from a when there's financial turmoil or a storm, that asset may also fall with all the other assets in the portfolio, right? The safe haven is special because it protects you when you need it the most, in a stock market crisis or a financial crisis, and gold works pretty well here. The concept is often misunderstood. What I often read in the financial press still is that when there is a safe haven event, so then stock markets fall, gold price goes up, but then after that, after this initial shock, usually after 10 days, then the gold price can fall because you don't need that insurance anymore, right? You have that insurance payout, which is essentially the gold price goes up. But when the shock dissipates, and then when the stock markets recover, you don't need that safe haven, the port, anymore, right? So then you can leave the port. So then, of course, the gold price goes down, or like any safe haven asset can then correct after the shock. And then the financial media sometimes calls that then now gold or whatever asset has lost its safe haven property. But that's not the case. You got your payout, and then it has to go down. It's part of that safe haven property, right? Otherwise, it would always go up. I mean, that would be a dystopian or utopian asset, right? So it's part of it, and that's often misunderstood. Think of like insurance. You buy insurance, you have to pay for it, and when the insurance event hits, you get a payout, right? But you still, after that, you have to pay the premium again, right?
Yeah, you've just touched on one of the bear cases for gold. Maybe we'll take the conversation that direction now, because I'm really trying to understand what's the downside here. And I mentioned it to you before any of the record button, Dirk, is like I'm struggling coming up with bear cases besides world peace. Okay, from the geopolitical side. Help us understand, like, what are the potential downsides here for gold? That's why, like, sort of leading up to this question, the last 15 minutes, like, what should we be afraid of? Like, will the ship leave the harbor at some point again? Do we need it?
Yeah. I mean, going back to the start of our conversation was that I said central bank demand has been a key component in that recent rise in gold, right? So we can think of a scenario where central banks now decide like, like we thought gold is a good idea, but we have changed our minds now, and we will sell the gold that we recently bought. I don't see that this will happen. I don't see any case why that should happen, but that could be a bear case, right? More generally, I think, and you alluded to it, is that we have a lot of geopolitical risk currently, right? We have a war, we have Putin, Trump, they will meet soon, but there's a lot of uncertainty, right? The tariffs don't help. The trade war doesn't help. So if this goes away, right, or if next week they Putin and Trump come to an agreement, and everyone believes that this agreement will hold, that's important, right? That no one changes his mind. And if then Trump makes up his tariff war and said like, I will have lower tariffs or no tariffs at all. I mean, this could all be good news for the world economy, but those good news will be bad news for gold, because as that's a famous, it was cited in The Economist many years ago that gold loves bad news. So then, of course, good news is not good for gold. And that's the bear case, right? Things change in a very good way for us. Peace, less geopolitical risk, less uncertainty, very strong bear case for gold.
No, it makes sense, but I have to admit, I don't see it happening anytime soon. So it's tough scenarios to believe in, sadly.
And I didn't say that it will happen, right? We are just thinking of scenarios, right?
Yeah,
right.
No, exactly.
Yeah.
Exactly. Does gold have any competition as a safe haven? Like, it's always hailed as the ultimate safe haven. Others have thrown the US dollar or even the bond market or the bonds into that discussion as well. But is there any competition for gold?
Yeah, I mean, in terms of the safe haven assets, US government bonds are, or high quality government bonds, German government bonds, Swiss government bonds, also currencies, Swiss currency, the Swiss franc usually. US dollar used to be there's some evidence that this has weakened now, right? But I mean, there are other safe haven assets, but clearly there is a big difference, right? Gold is, what I like about gold here is that there's no government behind it, right? A lot of, the US government bonds have been very, very strong safe haven assets. Also, because whenever they weren't, then the U.S. government, the Fed, stepped in and provided liquidity. Right? Given that gold doesn't have that, and it still did that, one could argue that gold is even a stronger safe haven. And clearly, it is one big benefit is that it's independent of governments. Right? That's a big claim of that. Those Bitcoin people too, right? That Bitcoin is decentralized and doesn't have a central authority backing it, and that's the same for gold. I mean, the whole thing is based on. I think when you look at the Bitcoin, then you see that this is all kind of borrowed from gold anyway.
Calling Bitcoin digital gold, do you think that's a fair term? Like, or should we even be using that? Like, I know it's quite controversial calling Bitcoin digital gold. What do you make of that term? What's your opinion on that, Dirk?
Yeah, I looked at it. Like I did also some research where we compared the mining, just the mining perspective, for example, and it's quite amazing that that I was a little bit surprised, because I thought that maybe that's a strong, like a little bit overblown. But it is heavily, like the whole concept is taken from gold, right? But then it's simplified. So, and given that it is simplified, you could argue that it's digital gold, right? It's a very, I mean, and digital gold doesn't mean that it's the same gold. It has different, as we know, the properties are still very, very different. But the design and the structure, there are very strong similarities. And I think the statement that it's digital gold is warranted, in the sense that very similar, but simplified, right? Is what you may expect from a digital version of something anyway.
No, it makes sense. Makes sense. I understand the properties and where people are coming from on Bitcoin here in general. Dirk, in 2022, you wrote a paper starting with the title, "Not All Gold Shines in Times of Crises," or in crises times. Can you elaborate on that? Like, what do you mean by that? How's gold different?
Yeah, sure. Well, we looked at gold bullion and gold shares, and with a focus on the COVID outbreak, right? And what is amazing here, is also a big profit opportunity for investors, actually, is that when a crisis hits, when you have a safe haven event, right, a strong stock market falls and turmoil, then gold acts as the gold bullion acts as a safe haven, so the price is stable or even goes up, right? But gold shares are not safe haven assets. They fall. They usually are linked with gold in general, right, in the long term. But in a crisis, they fall. They are pulled down by the stock market, because gold shares are equities, right? And then what we find is clear evidence that then the link to gold weakens. It decouples with gold, and the stock market dominates and pulls down the gold shares, right? So gold shares are not a safe haven asset. They decouple in a crisis. But then, of course, you can now guess where I'm going to, is that if you can predict, which is always hard, but I mean, if you see the bottom of that crisis, or the height of the crisis, and you can see that in COVID was after 6 weeks when markets started to recover, then you have quite a profit opportunity here, because then you can anticipate, and this has happened in the past, that then the gold shares have to go back to the link with gold, right? And then they will recover, move up to where they were before.
Just to clarify, when you say gold shares, do you talk about the exchange traded ETFs, or are you talking about gold mining stocks? Just to clarify.
Gold mining stocks. That's good that you asked that. I'm talking about gold mining stocks, gold shares, gold ETF, gold bullion. So they have strong core movement, right? So there's not much difference, right? As we know, well, or we would anticipate that the gold ETF is fully backed by gold bullion, so it should move with it, and that's the case. Yeah. So gold shares is really just gold equities.
Makes sense. No, great segue. Didn't plan it that way, but let's talk about the gold mining stocks a little bit, and how they've been performing as of late, and how do they factor into your research? Like, is there opportunity still left here at these price levels? We're seeing quarterly earnings come in now, just the last couple of weeks. How are they going? Like, what is your academic opinion on that?
Yeah, well, I have just finished a paper, I think 2 months ago, about the relationship between gold bullion and gold shares. And we started that project, was motivated by the fact that gold shares generally underperform. They seem to do poorly relative to gold bullion in the long run, right? And we tried to understand why that is the case, and whether that's actually the case or just a myth, right? And so what we find is that clearly you can, in this case, it makes sense to pick. I'm usually against picking stocks, right? But of course you can, like, if you think you have the ability, you can do it. So there are gold shares that clearly outperform gold bullion, but a portfolio, our argument is that if you have a diversified portfolio of gold shares, that is, let's say 30, 40, 50, 60, or like in the one of the major gold shares ETFs has, I think, around 60 in its portfolio. That when you have a large portfolio, it's unlikely that this large portfolio will outperform or even perform as well as gold bullion. So it's maybe a little bit surprising, but one of the reasons could be that as a gold miner, you constantly have to grow your reserves you mine stuff and then you have to replace that, right? And if you don't, what you can think about it, what will happen if you have a set, like you have a deposit and you mine that, so that of course then that will decrease over time. So then the valuation of that company should also go down, right? All else equal. So you have to constantly replace it. That's costly. Then there can be many other issues, many other risks. They're exposed to many other risks as well. And so it's not surprising that a large portfolio of gold mining shares underperforms gold bullion. And clearly, historically, there's strong evidence for that. But we also provide some theoretical arguments for it.
Yeah, I've been quoting historical correlations of 3-to-1 of gold mining shares to the bullion in terms of outperformance, assuming, let's say, gold goes up 25%, the stocks should go up 75%, roughly. Is that what I'm saying here? Am I like sort of making myself out to be a charlatan here, or is that actually is that a fact? Does that make sense?
Yeah, the 3-to-1, I don't find that empirically. It's more 2-to-1 empirically. So that leverage, right? And of course, that leverage goes in both ways, right? So when gold goes up, the gold shares will go up by much more, double on average in based on my analysis. But when the gold price goes down, then of course, unfortunately, gold shares will also go down, and then not just with the gold price, but they will fall by much more, right? So then that means that gold shares are much more volatile, more risky, and then because you have more risk, you should also get a high compensation for it, which you will get if you are if you think of gold going always up. Well, then gold shares, like the right ones, will give you much more, because then the positive leverage will increase your returns, consistent with the higher risk you have to bear, right? Because if you invest in a gold mining firm, there's just more things can go wrong, so you need compensation for that extra risk.
No, makes sense. I was hoping it'd be 3-to-1, but
it is 3-to-1
for
some firms. For some gold mining shares, it is 3-to-1, right? But on average, on that, based on that recent research, 20 years over a 20-year sample period, the average is more like 2-to-1, right? But that doesn't mean that you can even find gold mining companies where you get a 4-to-1, 5-to-1, right? But on average, it's 2-to-1.
Yeah, it's like Newmont or so. This year alone has been outperforming like 3-to-1 already.
Yeah,
which is great.
Right. So if you use a shorter, we use 20 years. So if you use shorter periods, you can always find some like higher ratios. You can also, when you just you zoom into certain events, then it's very likely that you find companies when the gold price goes up by 5%, that then some gold shares go up by 25 or even more, right? 1-to-5, or like 5-to-1, 6-to-1. That's, you can find that, right?
No, I'm more interested in like in historical averages, of course, right?
Yeah.
So of course there's always unicorns that just explode. Dirk, we have 2 minutes left, and I just have a couple more questions for you. Is like anything that we don't understand properly about gold, like anything the market, financial media is completely neglecting to talk about or understand?
Well, I mentioned the safe haven is sometimes misunderstood, but I think I hope I clarified that. The other thing is that gold is an inflation hedge. I think that's a little bit misleading, because gold has like strongly outperformed inflation, right? So I think it's more correct to say gold is so much more than an inflation hedge. Like inflation hedge somehow is misleading, that it suggests that inflation goes up, gold goes up, right? But gold does so much more, and usually goes up by much more, because there are other factors that come in, right? The other thing that I've looked at into banking regulation, right? High quality liquid assets, and then what is also surprising there is that gold is not a HQLA, a high quality liquid asset yet, and I find that interesting and a little bit surprising, because we know that gold is held by central banks, right? But then for commercial banks, it is not considered a high quality liquid asset. That's something that I've done some research on that, because it meets all those criteria. And you would also think that it does, because central banks rely on it.
Dirk, we got to do part 2 now, because you seem to understand Basel III, because nobody else seems to understand what that really means and how that's being reflected anywhere. So we might have to do a part 2. But I do have one very last question, Dirk, for you. And it's like, what's your estimate of how much gold China actually owns?
I think they own much more than what they report, right? But I don't have an exact estimate. But I think it's, well, there's even some history of underreporting. It would also make sense that you underreport anyway. You have an incentive, right? Show me the incentives, I show you the outcome. Yeah, I wouldn't be surprised if they had like much more, whatever much more means.
No, fantastic. Because that opens in a whole door of questions yet again. Like, I know you've been talking in other interviews about potential gold standard returning and things like that as well. So that opens a whole different can of worms. Dirk, really enjoyed this conversation. Really appreciate you joining us here on Soar Financially. Really great discussion just on gold in general. How can we follow you? How can we follow more of your work, Dirk?
I have a SSRN, like where we upload all our research onto a SSRN, is a social science research network. So all my papers are there. I mean, if you Google me, you can if you just type in my name, you will see get all my research, get the recent research papers as well if you have an interest in that.
Fantastic. Awesome. Dirk, thank you so much. Really, really appreciate you joining us. And we'll have to do part 2. Maybe we'll do that as a live or so, just to understand, like, what is Basel 3 and how much of that is in the price of gold right now? And what's the really, really interesting. No, really appreciate you joining us, and everybody else. Thank you so much for tuning in. Hope you enjoyed this conversation with Dirk Baur. I tremendously did. It's always interesting to look at gold from an academic standpoint of view and just leave emotions out of it and just look at some of the facts that are working in our favor right now, and just also understand the bear cases for gold as well. What are your thoughts? Like, how much of if you were to draw a diagram, how much would you assign each percentage to each category, like geopolitics, jewelry demand, central banks? Like, it's all big hodgepodge. Really curious to hear from you. If you haven't done so, hit that like and subscribe button. Helps us out tremendously, and it's free. So thank you so much for doing that. We'll be back with lots more. Take care out there.